Hey everyone, and welcome to today's Explainer. Today, we're diving straight into a massive business challenge. Honestly, it's absolutely crucial whether you're running a massive multinational corporation or gearing up to crush your ACCA financial management exam. We're talking about working capital management. You can think of it as the ultimate balancing act, right? On one hand, you literally just need to stay alive. You gotta have enough liquidity, enough cash on hand to keep the lights on. But on the exact opposite side, you have this relentless drive to make money and maximize your profitability. Lean too far toward liquidity? Well, your cash is just sitting there doing absolutely nothing. But lean too far toward profitability, you risk a catastrophic cash flow crisis. So let's figure out exactly how to master this high-wire act. Okay, so here's our playbook for today. We're going to break this whole business machine down into its core parts. First, we'll look at the working capital cycle as a whole. Then, we'll unpack the specific gears driving the whole thing: inventory management strategies, receivables and credit policy, optimizing payables management, and finally, cash management models. All right, let's jump straight into Section 1, the working capital cycle. It's all about liquidity versus profitability. So, a major danger in business is a phenomenon called overtrading, which you might also know as undercapitalization. This basically happens when a company grows super fast, but they just don't have the cash to support that growth. Imagine this. Sales are absolutely soaring, but the bank account is practically empty. That's why we need to visualize the actual timeline of your money. Your cash operating cycle is simply your inventory days plus your receivable days minus your payable days. The entire goal here, the core objective, is to minimize the cash tied up in working capital. You want this cycle to be as short as humanly possible. But, here's the real catch. You have to shorten it without running out of stock, without triggering a bunch of bad debts, and definitely without angering your suppliers. So, the absolutely crucial takeaway is summarized perfectly right here. Working capital equals manage inventory, receivables, payables, cash. Shorten operating cycle. You're going to want to lock this one-line summary in your memory. It's essentially the golden rule that dictates everything else we're about to cover. Moving right along to Section 2, inventory management strategies. To hold or not to hold. I want you to ask yourself this pivotal question. How exactly do we balance the cost of holding inventory against the very real risk of running out, which we call a stockout cost? I mean, if you hold way too much, you're just bleeding cash. But if you hold too little, you lose sales and potentially you lose loyal customers forever. We're basically dealing with two opposing financial forces here. In one corner, you've got holding costs. This is your storage space, your insurance, the risk of stuff going obsolete, and of course, the finance cost of having your capital tied up. In the other corner, you have ordering costs. These are your delivery fees, administrative time, and inspection costs. If you try to order in massive batches just to keep your delivery and admin costs low, well, your holding costs are going to shoot right through the roof. It's a constant, never-ending seesaw. Enter our mathematical weapon, the economic order quantity, or EOQ. The formula looks a bit intense, but it's just the square root of 2 times D times CO all divided by CH. So what does that actually mean? Well, D is simply your annual demand, CO is your cost per order, and CH is the holding cost per unit per year. By plugging in these exact numbers, EOQ calculates the mathematically perfect order size to completely minimize your total inventory costs. It basically finds the exact perfect balance point on that seesaw we just talked about. But, EOQ isn't the only game in town. Let's compare that traditional EOQ method with JIT, or just-in-time manufacturing. EOQ relies heavily on mathematical certainty and assumes you're definitely going to hold inventory. JIT, on the flip side, aims for literal zero inventory. Materials are delivered exactly when they're needed on the production line, like magic. JIT drastically, and I mean drastically, reduces those holding costs, but it requires incredibly reliable suppliers and a flawlessly efficient production system. Because think about it, if just one delivery truck breaks down under a JIT system, your entire factory might grind to a halt. To really cement this gear of our machine, just remember this. EOQ equals the square root of 2DCO over CH, JIT equals zero inventory, high supplier reliability. These are two very different, but very powerful ways to tackle the exact same problem. All right, let's shift gears to Section 3, receivables and credit policy, winning sales versus tying up cash. Go ahead and put your strategic advisor hat on for a second. Should you actually offer credit to win sales if it risks bad debts and having your cash tied up? Offering generous credit terms, say giving a client 30 or 60 days to pay, is a fantastic marketing tool. It wins over customers for sure, but it also creates all these administrative costs for credit checking and collection, plus the financing costs for the cash you don't actually have in your hands yet. And then there's the ultimate danger, the massive cost of bad debts if that customer suddenly goes bankrupt. So if your receivables are just absolutely choking your liquidity, how do you accelerate that cash flow? Our source material gives us two main rescue methods here: factoring and invoice discounting. With factoring, you literally sell your receivables to a third party, a factor, for immediate cash. They usually give you an 80 to 90% advance right up front. And if it's non-recourse factoring, the factor actually takes on the risk of bad debts themselves, though, as you'd guess, they'll charge a much higher fee for that peace of mind. Invoice discounting is slightly different. You simply borrow cash against the value of your receivables. Your company still goes out and collects the debts from the customers, which makes it a cheaper option than factoring, and it's completely invisible to your buyers. Let's crystallize this section really quick. Receivables equals balance cost and benefit. Factoring equals sell receivables for immediate cash. At the end of the day, it's all about ensuring that the sales you're winning don't end up bankrupting you while you're just sitting around waiting to get paid. Okay, on to Section 4, optimizing payables management. Maximizing days versus supplier relationships. Here is a highly practical question that trips up a surprisingly large number of businesses. If a supplier offers you a 2% discount to pay your invoice in 10 days instead of your usual 30 days, should you actually take it? I mean, is giving up 20 days of sweet, sweet liquidity really worth a 2% discount? To figure out if that discount is genuinely worth it, we have to calculate the annualized cost of ignoring it. The formula is the discount percentage divided by 100 minus the discount percentage. Then you multiply that by 365 divided by the difference between your normal payment days and the discount days. Okay, let's use our example, a 2% discount for paying 20 days early. If you run those numbers through the formula, so 2 divided by 98 multiplied by 365 divided by 20, the annualized cost comes out to a massive 37.2%. What that means is ignoring this discount is the exact mathematical equivalent of borrowing money at a 37.2% interest rate. It is incredibly expensive to ignore. If your bank overdraft only charges you 10%, you should absolutely borrow from the bank just to take that early payment discount. No question. To really anchor this payables lesson, keep this in mind. Payables equals delay payment, but don't damage relationships. Compare discount cost to borrowing cost. Delaying is obviously great for your cash flow, but only if the math makes actual sense and your suppliers stay happy with you. Finally, let's hit Section 5, cash management models, liquidity versus return. So we've successfully managed the cycle, the inventory, the receivables, and the payables. Now we've got to optimize the cash itself. Let's pose a really critical question here. Why hold cash at all? Think about it. Idle cash just sitting there in a checking account earns basically zero return. It doesn't grow. So why do businesses even bother keeping it around? Well, there are three main strategic reasons to hold cash balances. First up, transactions. You just plain need cash for daily operational stuff, like paying wages and settling the regular bills. Second, we have precautionary motives. This is all about building a safe buffer for unexpected events and emergencies. Stuff happens, right? And third, speculative motives. This means holding on to cash so you can strike incredibly fast to take advantage of sudden, unexpected opportunities, like maybe a competitor's liquidation sale. So, how much cash should you actually hold? Let's check out two famous models. The Baumol model is interesting because it treats cash almost exactly like inventory. It assumes your cash flow is highly predictable, and it uses a formula that's almost identical to EOQ to calculate the absolute optimal amount of cash to transfer from your interest-bearing investments right into your checking account. But let's be real, what if your cash flows aren't totally predictable? That's when you use the Miller-Orr model. This model fully embraces uncertainty by setting an upper and a lower limit. If your cash hits the upper limit, boom, you buy investments to bring the balance back down to a target return point. If your cash drops down to the lower limit, you sell investments to bring it back up. It's a beautifully dynamic system built for the messy real world. Let's lock in this final technical concept of the explainer. Cash equals balance liquidity and return. Baumol equals EOQ for cash. Miller-Orr equals uncertain flows of limits. And just like that, we've reached the end of our machines breakdown. We've explored every stage of the operating cycle together. So I'm going to leave you with a provocative thought to chew on for your own business or as you prep for your ACCA FM exam. Have you truly mastered the high-wire balancing act between staying alive with cash and actually making money through optimal efficiency? Take some time to review these slides, really master these trade-offs, and start applying this strategic playbook. Thank you so much for joining me on this explainer, and as always, keep learning.